David, can I buy a house?
God, Jim, we think it's a great time to buy a house. And not only have the rates come down, some of the programs have actually opened up their guidelines, and we still think a lot of inventory is starting to come back on the market. So yes, we think it's a wonderful time to buy a house.
Hey, today we are with David Frank, who is a senior loan consultant at US Bank, answering all your questions on loans. David, welcome.
Well, thank you, Jim. Great to be here.
So, get a lot of questions these days from our buyers, and one of the things they're asking about is, what is a 2-1 buy down? Can you kind of take them through how that works and the advantages for them?
I sure will, and it's got advantages for the borrowers, Jim, and it's also an advantage for the sellers of properties, where the seller will literally credit the buyer interest. So, for example, today's rate on a 30-year fixed is 5.625.
Mm-hmm.
For the first year on a 2-1 buy down, the rate will be 3.625.
That's the 2.
Exactly. And then the next year, it would be 4.625, the 1. And it's not only a 2-1 buy down. Typically, 2-1 buy downs are your jumbo loans. So if it's an adjustable rate mortgage, if it's a fixed loan over a jumbo portfolio loan by the bank, like US Bank, it would be a 2-1 buy down. Fannie Mae and Freddie Mac actually have 1-year buy downs, 2-year buy downs, and a 3-year buy down. So on the first year, it would be 3% off.
And how does that work? What's it cost a buyer or a seller to buy down that rate?
So the seller would be crediting the buyer, and typically it's somewhere in the 2 points is what happens. So when that seller credits the buyer, all they're really doing is paying that interest difference into a savings account in the buyer's name. So that's how it works. They're paying the difference in interest.
Kind of subsidizing it?
Subsidizing, a great way to put it. And another part of it that makes it that people should understand, let's say in a 2-1 buy down and a year from now, the rate is down. Rates are down and that buyer wants to refinance. That extra funds that were not used will be used to buy the principal down. So if they were to refinance before the 2 and the 1 discount, the extra sits there in an account that can be used to buy the principal down.
Good to know.
And where it comes up is, for example, for a seller today, and they list their price, you know, sometimes with this strange market, sometimes they'll have to lower the price. You know, they might have to lower it, let's say 2 points. In $1 million property, it's, you know, $20,000, but it's very much enticing to the buyers, because it could save them thousands of dollars the first year.
Got it. Why wouldn't you buy down the rate for the whole 30 years instead of just 1 or 2 years?
You know, and you can weigh off both options, James, and you're right. If this buyer, your borrower, your seller, your buyer, was to truly have this loan for 30 years, it would be better just to buy it down.
Mm-hmm. So it's more of a shorter term thing?
It's a shorter term where it breaks even. Mm-hmm. I mean, a lot of times with these high rates, it gets a buyer comfortable to go in because they're saving maybe $1,000 or $1,500 a month for the first year, maybe half that for the second year.
Got it. So, all right, well, that's good to know. 2-1 or even a 3-1 buy down.
Correct.
One of the other things I hear about are ARMs. 5-1, 7-1, 10-1 ARMs. What can you tell us about those?
I sure can. So all the loans fall into the same category, that they're 30-year amortizations. But that ARM, the adjustable rate mortgage, is the period that the rate is locked. So you might have a 5-1 ARM, 7-1 ARM, or a 10-1 ARM. And that initial number means that the rate is locked for that period of time. And then the one after it means it will adjust once a year thereafter. But again, a lot of times when people don't stay in their houses more than 7 years or 10 years, or back to where the kind of market we've had this last year with interest rates doubling in such a short period of time, it gives the borrowers or the buyers a lower rate for that initial period. And they still can refinance at any time.
Got it. And is there a cost to do that?
There's no cost to an ARM versus a fixed rate loan.
Okay.
But like I said, the rates are, for example, on a jumbo ARM right now, you're in the low 5%.
Okay.
When you might be in the mid 5s. So you might be 0.5% to 0.75% less on rate by taking an ARM.
One of the other questions that we get a lot is down payment. Do I have to put 20% down? That's kind of, I don't want to say old school, but a lot of people think you have to put 20% down. Is that always the case?
No, there's great programs out there, Jim, that you can put down as little as 3%,
Wow.
5% or 10%. For example, on Fannie Mae and Freddie Mac loans, a lot of their programs will go up to 95% or 97%. The thing that you just have to be aware of when you're putting less than 20% down, you're going to have some form of mortgage insurance. The nice part about it is, if it is straight mortgage insurance, once you do get 20% and enough time passes, you can actually get rid of the mortgage insurance off the loan.
Oh, that's good to know.
And something else to know, Jim, with two good borrowers at high FICOs, the mortgage insurance rates have dropped over the last couple of years.
I'd heard that, yeah. So that's good to know. So the old adage of you have to put 20% down is kind of gone. And then another thing that you know, if you're eligible, veterans can be eligible for up to 100% financing on a VA loan. Is that right?
That's absolutely correct, Jim. And for years, the VA loans were capped at the loan limits for Fannie Mae or Freddie Mac. But now the VA has there is no cap. And it's really the cost areas, but you could do $1 million VA loan with no money down.
Yeah.
And even higher in some areas.
Well, that's good to know. And you know, we've been fortunate enough to work with a fair number of veterans, and it's great to see them taking advantage of their benefit.
It's a great program. The VA loans are no mortgage insurance, no required down payment, and again, that comes back to eligibility and some other things, but it's a great program.
So one of the things recently in the news is that the loan limits went up, and I believe for a jumbo in Orange County, and it's area specific, it's now $1,089,300. What does that mean?
Yeah, well, because Orange County is a high cost loan limit area, high cost area, yeah, the Fannie Mae and Freddie Mac's loan goes, as you say, over $1 million.
So if you're below that loan amount, what does that do for you? And if you go above it, does that penalize you? What happens?
Well, if you're going to do a Fannie Mae Freddie Mac loan, right, you're going to be limited to $1,089,000 for the loan. There is a true conforming limit, which is $726,000 and change right now. And some of the guidelines are a little more flexible there, or you can go less down payment. They're both great programs, both have abilities to put less than 20% down, and they have great rates.
So if I'm above that limit, let's say I'm buying a $2 million home, 20% down, I have to go to a jumbo loan.
Yeah, and everybody used to think, Jim, when they heard the word jumbo, the rates are higher. And actually, it's just the opposite right now, because the jumbo loans are portfolio loans that the banks hold on their books. And being that they're holding on the books, they could actually offer lower rates than Fannie Mae and Freddie Mac. So a lot of times it's better to go to a jumbo loan.
Can I go to a jumbo loan below that $1,089,000?
You sure can.
Wow. Well, that could be a good strategy.
A lot of times, Jim, we'll do the jumbo loans down to $500,000.
Oh, wow.
And it's a big savings on interest rates.
Well, that's good to know. Now, tell me, if someone's got really good credit and somebody has not so good credit,
Yes.
do they get different interest rates?
They do.
Oh.
You know, there are what we call them as loan level pricing adjusters, Jim. And I don't want to be so detailed, but yes, the person that has some, and really it's not as high as you think. Anything over 740 is going to get the best rates.
Okay.
Everybody always thought they had to have 780 or 800. It's not that drastic. It's really when you get below 700 that you're going to see an addition added to the rate.
Okay. Well, so how can buyers make sure that their credit score, their FICO score, is high enough to get that best rate? Are there things that they can do, or is it beyond their control?
No, the best thing they could always do is start on the pre-approval process early, so at least we can look at the credit, and if there's something that's dragged their credit down, we can cancel them and say, hey, you want to pay that credit card down below a certain percent. If there was something derogatory that caused it, we can point that out and maybe they can get it fixed.
Well, that's good to know. And but that takes time. That's why you want to start early.
Exactly. Except if there's something on there that they were unaware of and they're in escrow, it's hard to really make a quick fix on it.
Yeah, you don't want to wait till you're in a 30-day escrow to try and fix something that might take 2-3 months.
Correct.
So. One of the other things that comes up is some people call it DTI, or debt to income. And basically, as you might recall from past videos, if you make $10,000 a month and your debts, mortgage, car payments, student loans are $5,000, your debt to income there is 50%. Does that impact what you can buy and what you can borrow?
Debt to income is one of the very important numbers that we do look at in the lending industry, Jim. And yes, as we've talked about, like Fannie Mae and Freddie Mac loans, yeah, some of those loans you can go up to 50% debt to incomes, where the jumbo loans you might be limited to 45%. So it really dictates if you have, like you said, a car payment, credit card, maybe student loan, and then you add everything for the house. The principal, interest, taxes, insurance, HOA on top of that. So that definitely is important on your lending, what you're going to qualify for.
Well, that's good to know. And then does the way you take your income, does that impact that? Like, meaning if you're self-employed or salaried, or if you're in a waitress situation where you're getting, or waiter, where you're getting paid in cash, how does that impact it?
Yeah, the way people get paid definitely makes a difference. And you talked about the first one being like a salaried W-2 employee. We get to use every bit of that. If they're, by a chance, they get commissions, we'll need to see that they had a 2-year history to be able to use that commission. And then for the self-employed, we have to see their tax returns, how they're showing their income, to decide what we can actually use. Because I hate to say, sometimes we do run across self-employed borrowers that make more than enough income, but they have good accounting and they don't show it all.
Yeah, so we had a client who owned a gas station, and when he was getting ready to buy a house, he had to take more income out of the business to qualify for the loan. So it's kind of a little bit convoluted, but his accountant got it done. So.
And again, that goes back to starting early on the pre-approval, because we were able to help many self-employed borrowers with the same thing. All they had to do was show W-2 income for a short period.
2 years?
No, we were able to do it for less. But by doing that, they were able to get that income they needed.
So over the years, and David's helped us with a lot of great buyers over the years, and it seems like some of them get different types of loan programs. What type of loan programs are there, and what is the difference?
That's a great question, Jim, and luckily there are so many different loan programs. Everybody knows of Fannie Mae and Freddie Mac's because it's a very well-known household name. Great loans can go to high loan to values, not always 20% down. Also as an option is an FHA loan. And an FHA loan, if somebody maybe doesn't have as good as credit, or they might have lower income, we can go to a lot higher debt to income ratio.
All right.
With that lower credit, you're going to have higher mortgage insurance. But it's still a great loan to get people in a house.
To get into a home, start building equity, and start in being an owner rather than a renter?
Correct. It's a great program. And then behind that, you have VA loans, then the jumbo loans, and then there's also what's called a non-qualified mortgage. Sometimes it's great for your buyers that are maybe self-employed but don't show income. So there's different loan programs to meet everyone's needs.
Well, that's good to know. And most loans are 30-year, but I see occasionally 15-year, and that's basically so you pay it off sooner. Are those still getting a lower interest rate?
They do. Yeah, if you do a shorter term loan, and typically it's the 30-year and the 15-year. There's also 20-year, 10 years, and to be honest, now the way they have it on a Fannie Mae or Freddie Mac, you can dictate anything from 1 year to 30 years.
Now, I've heard of 40-year loans. Do you see many of those?
We don't see many anymore. It was definitely a big thing in the early 2000s, but we're not seeing them at this point in time.
So one more thing. I'm assuming you brought your crystal ball. What do you see as interest rates for 2023 as we're getting out of 2022? What's going to go on next year?
Well, that's a two-part question to me. We had 2022, which we saw rates increase at a faster pace almost than ever before.
Well, percentage-wise, faster than ever.
Everything lines up looking like we'll have some type of recession. And I'm not one to say, oh, it's going to be this or that, because the markets move so quick. But historically, anytime we had a recession, the rates do pull back.
Yeah.
And we really do feel sometime in 23, you'll see the rates drop a little, but really if it's 23 or 24, we do feel the interest rates are going to drop.
Do you think we'll see back to the 2s and 3s, or from the 5s to the 4s?
Personally, I think it's closer to the 5s, the 4s, maybe the high 3s. I can't see any reason that will bring us back to those historically low rates.
Yeah, something to keep in mind. Don't wait for those days to come back.
Yes, that's a great way to put it, Jim.
So, David, thanks for a lot of great information. As you can see, it's really important to talk to a mortgage professional like David. Earlier is better if you're planning to buy, because there's a lot of moving parts that can affect your rate, affect what you pay on a monthly basis. In our past videos, we talked about, just that little percentage difference, it can be $500 a month pretty easily on what you're paying every month. So any last words?
No, I think, Jim, the most important thing you mentioned there is really start early, because a lot of things can be fixed during the process. It's a great time to buy always.
Thank you to David Frank with US Bank. I'm Jim with the Bishop team, Berkshire Hathaway Home Services.